Hi and welcome to Panzer Bank. My name is Markus Almerud and I'm an analyst here at the bank. I have with me today Maha Energy, who released earnings this morning. And I have the CEO, Jonas Lindvall, and Andres Modarelli, who is the CFO of the company. So hi guys, and very warm welcome and thank you for doing this.
Thanks, Marcus.
Hi,
It's always a pleasure.
So nice, nice results, nice quarter. And let's start with production because, everybody knows what's been happening with oil prices, obviously. But it was not only that. You had a record quarter in terms of production levels as well. So let's start there. You were about 30% higher than the previous highs in terms of production volumes. Is it fair to say that, was there anything special happening in this quarter, or is it fair to say that we have indeed reached a new level and maybe even that we should expect a further ramp up in incoming quarters?
I think that's a few questions in one question there, Marcus. But let's start. Yes, we did have a record quarter. We're very happy with that. That was primarily driven by the well results of TA4 in our T field in Brazil. It tested 4,400 barrels of oil per day on a 24-hour test. And that contributed tremendously, obviously, to our quarterly production. And yes, we are currently above our guidance for the year. However, we've also said that we have some quite key workovers coming up in the second quarter, where we are now, on some of our existing wells in the same field. So yes, it is fair to say that in the coming quarters, we will see, a new level arising, it's sort of step change for the company as we transition the T field, which is really our cash cow in Brazil, from sort of primary production into harvesting that asset, and we can then focus on our other assets and bringing them also in production.
Mm-hmm.
So we're very happy. Obviously, the increase in production and also obviously the high oil prices have contributed to really a stellar quarter for us. We're very happy with that.
And let's stay there a little bit in Brazil and dig into it a little bit. So if we start with T4, how is it ramping? When did you start production? When did it come into production? And are you kind of producing in full, or should we expect a further ramp up from where we are now?
So TA4 came on production at the end of January. It is a vertical well. It was originally intended to be a horizontal well, but we had tremendous problems in the build-up section there. So we had to abandon that temporarily and complete it as a vertical well. It came on, I would dare say, well above our own expectations. So it speaks to the quality of the Agua Grande and Sergi reservoirs. We have two reservoirs, stacked reservoirs here. It came on at 4,400 barrels, like I said. But that's a test result, and that's not what we're running it on. It's also our first ESP in the field, electric submersible pump, which generates much better drawdown effects on the reservoir than our jet pumps. There's some disadvantages of running ESPs as well, but so far, knock on wood, the ESP is holding in there very well. But we have to balance that production across the field, right? So right now we are producing from 5 wells in the TA field, and we're trying to balance out the production there so that we get a uniform sweep across the reservoir. Something that we've been harping on for a long time, which is the water injection. We're behind on water injection, and that really is key for, increasing the ultimate recovery of the field. So, we are transitioning this field now from a producing field to, let's call it an injecting field. So, to that extent, we recompleted TA3 as a flank injector. Our next well our next 2 wells are going to be water injectors. So, TA field will continue to deliver, excellent reservoirs. And I do see some hiatus in the near term, maybe the next few months, as we do some workovers on existing wells. But after that, it should be fairly smooth sailing.
And the workovers you're talking about, is it the T3 which you do some work on, and then if you look over time, should we expect them to, when you have these kind of workovers, that you will have kind of stable-ish production because you will go up in one and down in one, and then you will kind of level them out? Is that how we should see it?
That's in theory how it should work out, yes, and that's what we've planned for, and it gives us some redundancy, especially with the TA4 and TA5. It should give us that redundancy in terms of in case one or two wells go down temporarily.
Mm-hmm, mm-hmm. And let's come back to T5 in just a little bit, and let's continue a little bit with production. So if we move on to Tartaruga, what are you seeing there, and how does that? You were talking about it being back to kind of pre levels. So where do you stand there? And do you also expect a ramp up in terms of Tartaruga?
Yeah, Tartaruga, we have two wells there. We drilled a third well to the north, which did not pan out for us. That was an appraisal well to appraise the northern part of the field. Unfortunately, the reservoir development was a little bit poorer in that area. So we're concentrating in the southern fault compartments that we're already producing from. And those two wells, I mean, they've, Tartaruga 2 has been in production since 1994. And Tartaruga 1 has been in production since 2006. So, we need, if we're going to expand production, then we need to drill. And the plan is to drill another horizontal sidetrack in the Pinedo 1 sandstone, which is very thick and very nice. And we are confident it will give very good results. That is to start to drill that towards the end of this year. We would drill it faster if we could, but it's a drilling rig issue. There's just not enough drilling rigs in Brazil. So we have to get in a schedule. We have to get in a sequence.
Okay. And we'll come back to, you touched on a couple of things which I'll come back to, and drill equipment is one of them. But just to finish off the production, Illinois. So you started two wells. You drilled two wells in Illinois during the quarter, right? And did they also start production? And if so, when did they start production?
Right. So Glaze 1105 was drilled. It was spudded at the beginning of March, and it was actually on production, producing oil by the end of March. So that was an extremely good operation, considering that there are multiple steps involved. So that was I think it was a record for us in terms of timing. From the time we got the drill bit in the mud, in the ground to we got oil in the tanks, it was less than 30 days. So Glaze of 11.5 is doing, I think the 30-day IP or 30-day initial productivity was 78 barrels of oil per day. So that's contributing quite nicely to the Illinois Basin. The other well was also drilled. That's a joint venture well. I think we have about 50% of that well. So it's, the volumes are less there. But that is also producing, not during the quarter, not during quarter one, but it's now in production during quarter two.
So to sum up on the production, I mean, we should see maybe some drawback from T3, and then T4 should continue to produce, and then you have some contribution from Illinois, but it's maybe not reaching in the shorter term the same kind of levels, or not for sure at least, and then ramping up towards the end of the year. Is that how I should see it in terms of
yes,
level?
That is exactly.
Okay. If we move on to drilling, and maybe starting with Oman, so how should we look upon Oman in the next year or so? And I mean, you started to drill in June, right? So and you say we'll get some more information on Oman during the second half of the year. Tell us a little bit about where we stand on Oman. Should we expect any volumes to contribute to overall volumes in 2023, etc.?
First off, Oman is now entering a very exciting phase. I mean, we have been working behind the scenes there since September. We have contracted a drilling rig. The drilling rig will be moved sometime in June. And, we're working very, very hard to spud the first well at the end of June. The first two wells they are basically data gathering wells, so I wouldn't expect very much. For us, it's very, very interesting and very sexy, but maybe not so much for the market. We need that information to determine exactly the size of the pool that we have, and to determine where we can inject our produced water, because we expect to produce quite a lot of water with this oil. Then after those two wells are drilled, so that would be sort of towards I would say September time, we can start drilling our first test wells. And we plan to drill 4 trilateral test wells. So there'll be a total of 12 well bores producing into basically a big test tank, where we will get some information about oil productivity in this field. That will then most likely be followed up with another 4 wells at 90 degrees. So here we're trying to ascertain, which way the faulting and the fracture system within the reservoir is located. And that's really important for us when we go to develop this whole field, because if it works out the way we want it, and we believe it will, you're looking at almost 200 wells here on this field going forward, and quite large production, because it's a very big pool. If the oil water contact is where we believe it is, it's close to 500 million barrels in place, and that's only 450 meters depth. So it's very cheap drilling, very cheap development, be quite easy. With respect to volumes, I don't want to say anything on that. I mean, the plan and the idea is that these test wells will be placed on an extended well test, and any volumes from that will obviously be taken care of and sold. But it is a test at the end of the day. But it's extremely exciting. We're all pumped up here. I think there will be a lot of very interesting and exciting news coming in the second half of this year, so especially from Oman.
And let's say that things go the way you want and the way you plan. When do you expect, production to start? Not like test production, but real production to start.
Right. So, that's, it's a simple question, and I can give you a simple answer to that, Marcus, but I want to preface it by, it is, we are guests of the Omani government. We are a contractor to the Omani government, and it's their oil at the end of the day. So, they have a large say in how this gets developed and how it gets exploited. So to that end, the process is we would have to prepare a field development plan. And that plan is a very detailed document. You can imagine, especially in this case here, when you're talking heavy oil, limestone reservoir, multiple laterals, evacuation routes, etc., etc. It's a lot of work, and the steps would then be submitted for a field development plan, declare commerciality. Once the government says, yes, okay, we agree with you that this is a commercial endeavor, we want you to proceed, then we have a 15-year production period under the contract with the government. Our plan, if it goes as we hope, okay, is to try and get that done as soon as possible. So as soon as we have this information, we would start working immediately on a field development plan. And then once you have declared commerciality, I would say it's probably between 12 and 18 months before you see your production ramp up. Okay. But, during that time, we would still have our extended well testing facility there. So we could continue to produce, albeit on a smaller scale, through those facilities. And that's the plan.
If we continue on the drilling and just quickly on T5, so when do you expect for that drilling to be done and then for production from T5 to be started?
So we expect to have that done here anytime. Hopefully before end of this month, and then on production before the end of June is what the goal is. Now, we have had a lot of trouble with surface equipment this time. A little bit of downhole problems, but not so much. It's been mainly surface equipment of the drilling rig that has caused quite a lot of delays with respect to this drill. So, knock on wood, hopefully we can, that does not slow us down. So, hopefully by the end of the second quarter, and that is as per our guidance as well. So we're not falling outside of that guidance.
And talking about the rigs, I mean, I gather that they are hard to get hold of, right? There's not enough rigs around. What's the reason for it? And is there any like light in the tunnel? Are they built more rigs? Is it COVID related?
No, it isn't a Brazilian issue. And the way it works is, for many years, Petrobras was the only company that ran, the onshore and offshore fields in Brazil. And as they liberate the market, more and more players come in. There is a need for third-party services, and that market has not developed fully yet. So at the moment, it's a very, very tight rig market in Brazil. The only way to reduce that is to bring other rigs in from other countries, and that may happen as the market dictates, but that comes at a fairly large cost as well. To move a rig in from, say, United States, I mean, you're looking at probably, $1 million and a half dollars just to get the rig, plus, probably 6 months, plus importation, etc. So it's a very specialized situation in Brazil. It's because it hasn't been an open market for very, very long. So that has led to the shortage of equipment and people.
Let's move on to cost. You mentioned the word cost there in just moving the rigs, but it's interesting to look at the operating cost because, I mean, obviously the operating cost goes up in absolute terms as production goes up. And also if you look at per barrel cost, you showed a nice graph and you mentioned the call as well that you're actually down quarter on quarter compared to Q4, that is. And you're up quite significantly in terms of per barrel cost compared to Q1. How should one, and this production cost, how should one view this? I mean, what should we expect going forward?
So I see overall factors, and then there's specific factors. I think the overall factors that to consider versus a year ago are we're seeing inflationary effect. So last year's inflation in Brazil was 10% or higher, depends on the index you look at. And then we have that the Brazilian real has appreciated significantly since the end of last year. We're looking at 15% appreciation at least. And so you have these two factors, on one hand, increasing your cost in Brazilian real, and on the other hand, increasing your cost in US dollar terms. So I think I see that as something, sort of an overarching effect. And then more specifically, there's quarters where we do undergo some of these, well jobs that are, they're costly and would have a high impact in that quarter's, OPEX cost.
And if I look going forward, I mean, if forget Q1 last year because it was much lower than the rest of the quarters. And if I kind of look at Q4, Q1 per barrel cost, should we expect inflation from current levels, or is it? I mean, there were lots of special factors here, but what should I expect? I mean, because we also see, I guess, as we come into the second year, at least second half, where production goes up, we should also see some effects of, the contribution going down as well. So from a higher amount of production should also have a positive effect on the cost base on a per barrel.
That's correct. but at the same time, as we add new wells, you bring in new costs to operate that specific new well. I think going forward, we will continue to be as we were discussing earlier, we do have a workover schedule ahead of us. Some of these workovers would be capex related, but for those that are OpEx related, they will have an effect in OpEx and will leave the levels more in line with our current levels, at least until we can complete those workovers.
And I would say two things to add to that is one is the OpEx that we present that's on a corporate level, so that includes basically all our operations. And when you look at it in that perspective, we're still a very low cost operator from an industry standpoint. And as I said in our earnings call this morning or this afternoon in Stockholm, I've been around in the industry since '86, and I've seen these oil moves. And when oil prices start going to these levels or maybe even higher, things start to get silly in terms of, some costs. And that's where it's important that you have that cost control structure within your organization, that you don't allow yourself to get swept away by these silly costs. You have to look at it, that old adage, the best thing against high prices are high prices. So one thing we do know for sure is that eventually high prices are going to drive the cost down or the prices.
Yeah. And I mean, talking about the margins are very, very good, and the EBITDAs are at record highs, and that, of course, leads to cash flows being very, very strong. And I mean, it's positive. It's encouraging to see free cash flows being positive in spite the quite significant investments that you're undertaking at the moment. So what is your view on this going forward? I mean, I know we talked about this before, but what are your thoughts about the use of this cash going forward? There were some questions about the bond and repayment of the loans, etc. But how do you have quite big investments going forward? So how do you view this? I mean, how do you view the cash position and the cash flow situation going forward?
We have been very diligent in acquiring these quality assets during a time when oil prices were low. So, our asset cost that we've developed is very low. And we have a very, very solid and very well thought out development program of those assets. So I think when you look at it from the perspective of net asset values that we will be adding here, future cash flows, this money is well spent on those things. The original plan was that we were well capitalized. Now, oil prices and increases in production has put us in a fortuitous position that we have spare cash, and the question then becomes, okay, what do you do with that spare cash? And because of how the loan is structured, there's little incentive for us to repay that loan early. Okay. So what do you do with that spare cash? Well, if you find projects that generate yields that are higher or better than what we're paying in interest, then you should apply that cash to those projects or those opportunities. And we are actively looking, for those kind of projects that can deliver better, yields than and that's the best way to deploy that cash. I think I'll leave it at that, unless you.
No, and I think just to add is that our loan is scheduled in the sense that it's amortized over the length of the loan, right? So we are going to start making principal payments over the next starting this year, and over the next 12 months, it's going to be about $15 million that we're going to start amortizing.
And what about dividends? I mean, is dividends out of the realm of possibility?
No, it's not out of the realm of possibility, and that's something that we've been actively discussing internally. There are two, as I see it, things that we need to address. First, I think there obviously needs to be sufficient cash to pay a meaningful dividend. And that has to be weighed up against, investments in capital projects. And the other thing that we have to consider is the loan conditions, right? There are certain conditions placed under the debt facility that we would have to address before we could make. But I think the primary one is the amount of money. I mean, there has to be sufficient funds in the kitty to make a meaningful and sustainable dividend policy for the company. But it is definitely something that we have been talking about at management level and also at board level.
Mm-hmm. All right. Finally, let's talk a little bit about the E&P capex. You raised it on the call, but it's quite interesting. I mean, we have seen a significant reduction at several levels of E&P capex, and I mean, you use words as supply squeeze, etc. So let's talk a little bit about that. Just some quick thoughts about this.
The oil and gas industry has really been hammered hard since 2014 on a bunch of sides. The 2014 collapse of oil price was driven by an oversupply of shale oil out of the United States. Okay. Now, that worked its way through the system 2015, 16, 17, 18. Demand was continuously growing during those years at about 1.5% on an annual basis. And stocks were slowly but surely being eaten away. Then came COVID, right? And everything just collapsed, right? I mean, the bottom fell out of the floor fell out of the oil market. But having said that, yes, we did have a substantial reduction in demand in 2020. And even in 2021, but I don't think it was as much as people were speculating at the time. People were saying that, in 2020 demand went down 30 million barrels. Did not. It went down about 8 million barrels a day consumption wise. As this data comes through, it paints this picture that, on the one hand, you've got the demand side, which is calling for crude and energy. And on the other hand, you have the supply side. And let's talk about the supply side, because the demand side, I think, is well documented and we're still growing. People are still calling for energy. On the supply side, what's happened since 2014 is that, the investments into the oil and gas industry, for new projects and development projects, has halved more or less since 2014. And I'm in my earnings call, I did say, I said, on average, between 2005 and 2014, for every barrel that was consumed, the E&P sector invested $16 per barrel in future developments. Post 2014, that went down to 12. And that doesn't sound like a lot, but it's a 30% reduction, over 7 years. And that is going to, manifest itself as a major problem for the global energy requirements. Okay, and so there's talk of, I think, $2 trillion, $3 trillion of shortfall in investment over that period of 7 years, and we already know that. I mean, Saudi Arabia has come out and said very clearly. They didn't mince their words. They said, look, we have no oversupply. UAE came back and said, we have no oversupply. And if you look at just say Saudi Arabia, they have never produced over 10 million barrels a day for a sustained period of time. So to believe that Saudi Arabia could just open the spigots and say, hey, we'll make up the 2 or 3 million barrel a day shortfall, it's not going to happen on a sustained period of time. So this is going to lead, in my opinion, to a supply crunch. And the UAE came out, I think, a week ago and said, look, we actually see, unless the world takes action and starts to invest serious amount of money in the upstream oil and gas sector, we see oil prices maybe doubling or tripling from the current levels. That would mean $200, $300 barrel. That's a situation that the world has never been in before. And then, of course, we add on top of that Ukraine, which I believe is a temporary issue. But the effects of that temporary action is going to manifest. Already the buzzword is energy security, right? Europe is now waking up to the fact that they're going to have to develop alternative energy supplies. And yes, renewables is one, but they're also going to have to rely on hydrocarbons to fulfill that shortage if they want to wean themselves off Russian oil and gas.
Mm. Gentlemen, time flies when you're having fun. So thank you very much for this. Super interesting topics. So thank you for being with us, and we'll speak soon.
Thanks, Markus.
Thanks.